All right, it's a 51 point uptick for the Nifty. Can it be flat than this? I don't think so. That's a Nifty start for you. It's again 129 point uptick for the Bank Nifty. The breadth today, at least there is some solace, if I may use the word, is looking better. It's looking meaningfully better than what it has looked in a long time. I'll identify first the stocks. I mean, I'm just not going to go on news per se. Yes Bank up 2%. Zomato flat start but strong volumes. Adani Power 4%. You've got 7% uptick in Adani Enterprises. Yep, 5 has become 6, 6 has become 7, and 7 is about to become 8. Wow, that's Adani Enterprises for you. 60 seconds and 2% has got added. What a recovery it's been in Adani Enterprises. You know, these were the levels from where, these are exactly the same levels from where some of these stocks took support in the month of Jan as well, when the selling had really intensified. So Adani Enterprises is clocking strong volumes. Adani Port is clocking strong volumes. Could today be the comeback? Could today be the comeback day for some of the Adani group of stocks? Reliance is looking strong. And Adani Total Gas, hello. For the first time after moving from circuit to circuit, I think it is off circuit.
Off circuit, but still in the red, almost about 2%, and these are just the first few minutes. Let's see where it actually goes from here. It seems like it's in a smidge of a recovery mode, however. A couple of other stocks which are going to be in focus. Let's see what Axis Bank is up to, considering they've completed Citibank India's credit cards business acquisition for 11,603 crore rupees. Axis Bank holding up 1% right now as we speak. HDFC Bank and the HDFC Council has said that there have been no objections to the merger at NCLT. Zydus Life, they've got the final US FDA nod for one of the tablets, and the Benicar HCT generic as well. So that's another stock in focus. Federal Bank, that's going to be an important one. The management is pretty optimistic on business drivers. Incremental ROA levers clearly spelled out. Federal Bank, though, marginally in the green as we speak right now. There's BEL as well, which has got a frame supply agreement with Thales Reliance Defense System. So that's another stock which is in focus. And it seems that at the Wadia Group, some reorganization is afoot. Bombay Burma, they're looking to sell 8 coffee estates right now. 2 Orange County resorts for a price consideration of almost about 291 crore rupees. Bombay Burma holding out smartly in trade as we speak. Airline companies as well, I mean largely only Jet, Interglobe Aviation and SpiceJet. Jet fuel prices have actually been cut. So that I think is going to be a little bit of a sentiment positive, but maybe not so much for the Mumbai-based real estate companies. I mean, Knight Frank has reported that Mumbai Feb real estate registrations were actually down 11% on year-on-year basis. And remember, this comes on the back of extremely great numbers all throughout the last 1 year. So yes, it was a high base as well into play same time last year. But yeah, most of these stocks are not going anywhere really. Delivery, SoftBank is the seller of that 3.5% stake is what we understand, and part of the block deal has already transpired. Delivery now at 341. For the index also, Kunal, it's not looking bad. We're almost scaling up 0.5%.
Yeah, I think it's a good start. Finally, we've started off a day on a positive note, and we are, even in the last couple of minutes, we're building on to those gains. From a 40-50 point gain, we almost had 87-88 points on the index, and there is evident amount of buying which is there on the large cap front. Recovery for few sectors like the metal stocks are getting into a recovery phase, at least the ones which are beaten down significantly, Hindalco, Jindal Steel, etc. So I believe that possibly if we manage to just sustain this gain of 50 plus points on the index, we could probably expect more short covering to come by into the other indices like Bank Nifty, etc. Would maintain a buy on Bank Nifty as well as in terms of individual stocks. AB Capital is something which would be bullish on at current levels of 144.45, and that's a stock which I would recommend to buy as well as would continue to buy.
All right, Naresh, let's get in your first trades as well as a quick assessment of how we've opened up for trade today.
So a good open on the Nifty and the Bank Nifty as well as the broader markets. I've not yet seen an uptick, but still a flat start is good to go with. Be bullish on the oil and gas space, so that is where I continue to add on to the position on IGL, looking to add on more above 445 levels. So looking at oil and gas as to be the sector which could do really well.
Krishna Kumar Karwa joins us. Let's take a conversation. Krishna Kumar Karwa joins us. Let's take a conversation forward and try and understand that what he makes of the current market setup. KK, good morning. Thank you for joining us. It's been 18 months and markets are pretty much jumping in the same place. The bulls would say that whatever could go wrong has gone wrong and markets have not fallen apart. But investors are now saying that, look, 18 months of no return and with a visible slowdown in the near term, are we in for a tough patch for next couple of quarters?
Good morning, Nikunj, and thank you for inviting me. Yeah, I think what we are going through is a proper reset. I think in terms of interest rates moving up, in terms of quantitative tightening, and there is a fundamental reset which is going in the market, and that is reflected in the stock prices. Thankfully, at least our markets at least are holding out and broadly saying maybe 5% from the top. But so I think this reset is still in progress, and also if you look at the narrative in terms of inflation and accordingly interest rates, I think that narrative has not yet settled. What was supposed to be transitory has now become kind of stubborn, and so we are not at the end of the interest rate hiking cycle globally and accordingly in India. So I think from our market perspective, investors need to be very, very patient. In the next few quarters, yes, there could be disappointments in terms of companies which are more focused on exports. There could be some challenges also on domestic consumption stories. So wherever valuations are rich and growth doesn't justify, I think those companies or those stock prices would be still under pressure. But having said that, I think looks like investment versus capex. So I think the capex oriented companies, consumption versus capex. So capex oriented companies seem to be in a sweet spot as far as investor interest is concerned, and I would think so that they would continue to do well.
So from a market standpoint and from a news standpoint, will it get bad before it gets better? And I'm referring to both the economic news, the earnings, and also the underlying stock prices.
I would say that it will be very, very volatile in terms of, I think there is no consistency as far as news flows are concerned. I think data keeps on changing and the narrative from central bankers accordingly keeps on changing. So I think volatility will be a given, and as I said earlier also, so volatility will be a given, and accordingly wherever valuations are not reflective of the fundamentals, I think those stocks will be under tremendous pressure. And also, as far as news flows are concerned, I think it's very difficult to say what can happen as far as the global scenario in terms of the Ukraine-Russia war. I think if some solutions are coming out of it, that could be a very big positive news. But as of now, it looks like that we should be prepared for slightly trending down kind of news flow rather than any massive uptick as far as global is concerned. And as far as local is concerned, I think this whole El Nino effect which could possibly come, I think that could be a dampener as far as local environment is concerned.
Right. So in light of your macro view on India and considering that you continue to remain in long-term bull, KK, wanted to understand what your sectoral overweights and underweights are in this current market.
So I would look at it in two ways. I think one is that in a rising interest rate environment, we need to be very, very clear that are we getting into a reset as far as valuations per se are concerned. So in that environment, it is very important that we are invested in companies where valuations are reasonable and not into companies where there could be 40 times and 50 times earnings 2 years forward. So those kind of valuations, companies could be under a massive derating possibilities of they getting derated massively. Now sectorally, it looks like that, as I said earlier, the capex cycle seems to be very strong. So companies, whether it is into power, whether it is EPC or manufacturing, etc. So that is one segment which will continue to deliver robust returns, including companies in EPC, cement. So that's one segment. And from a medium-term perspective, from a 3-year perspective, we believe that the whole manufacturing sector that has massive tailwinds as far as various government policies are concerned, as far as the whole China plus one, Europe plus one opportunity is concerned. So companies in that segment, they are going through a lot of capexes and they should deliver good returns. Yes, some of those companies in specialty chemicals, etc., have corrected, and maybe there could be some more sideways movement in many of these companies. But if investors are willing to invest from a 3 to 5 year perspective, I think the whole segment, including auto ancillaries, which are focused on exports, I think many of those companies will deliver very good returns. So this is one segment that you should be looking to add further in the coming months.
Would you steer clear from though?
See, as I said, I think wherever there is valuations are expensive. Now, instead of going sector specific, I think it would be very important that on a bottoms up basis, we are very clear that we are not investing into richly valued companies or where the expectations of earnings coming 3 years, 4 years down the line. Those kind of companies that you should avoid. And from an immediate next 6 to 12 months perspective, looks like domestic consumption still seems to be under pressure, and many of the companies in that segment seems to be expensive. So maybe that is one segment that you should be very, very careful in investing. And yes, we have seen a decent amount of sideways movement happening in the banking stocks. So working wise, there is no challenges in most of the companies. It's about over ownership. So I think there we'll have to be very swiftly trading in and trading out of those stocks, because over ownership is massive in that segment.
KK, does the kind of commentary that we've been getting from the new age tech companies now with respect to profitability, growing their businesses, reducing cash burn, inspire confidence?
Yes, I think we have already seen that in January we saw a massive, reasonable uptick in the valuations or the stock prices of many of these companies post their Q3 results and the commentary. My sense is that post their full year results in March, which will come in April, I think the indications that they give in terms of how the order flows or order conversions are happening, that should help investors become more sanguine and more confident about these business prospects for these companies. So they are coming. I mean, the last 3 years have been very good for most of these companies in terms of growth. So growth, there is a definite slowdown which is expected, but then these are cash generating machines and they do well over the period. So my sense is that different high single digit returns is possible in many of these IT companies.
Okay.
You got a nice little rally in Adani stocks. You got a nice little rally which is coming back in some of the metal stocks today. Good comeback in some of the PSU banks. KK, I'm sure your global clients, your HNI clients, your domestic institutional investors, they must be sending you a WhatsApp or a message, or maybe they must be calling on your landline to figure out, KK, what do you make of the Adani saga? The Adani of stocks, the Adani saga, the impact of that on the companies.
I think the challenge is, so I mean, yes, it has been a month since this whole episode has opened up, and as you can see, I think there was a lot of fear on the whole banking system, possible impacts, and maybe derivative 2, derivative 3 impacts on other stocks. My sense is that all that is possibly behind us, and I think it's now becoming business as usual, because I'm sure regulatory agencies will come out with various reports on whatever questions have been raised by the global research house. So I think investors are now back to looking at individual stock fundamentals and trying to take decisions rather than worrying about the possible macro impacts of whatever has happened.
So there are 3 things here. One, the volatility in Adani group of stocks. I'll keep that aside. Second, the domino effect it could have on lenders. As of now, there is no loan default, whether it's LIC or State Bank of India. They've come out and they've said that we have no challenges whatsoever because the Adani group of companies, they're still standard account. What is your understanding of the impact it could have on the lenders per se?
No, as you rightly said, I mean, there should not be any impact because I think all the lenders, if you look at the presentations also by the group, I think 70-80% of their borrowings is from global entities. So the local entities, the lending itself is very, very limited, and most of the businesses have sufficient cash flows to be able to service their obligations. What can possibly impact the ecosystem could be in future there may be challenges to borrow, and that could impact their growth plans. But as far as lenders are concerned, I think it's a more ghost which the investors have created. I think local lenders have been very sharp in their underwriting standards over the last many years, and I don't think so any lender has any massive over leverage, over exposure for them to worry. So I think the stock price correction which have happened in the local lenders is more a function of over ownership and the general market sentiment. And I think once the Q4 numbers come out, and maybe I think that things should pick up. So domestic lenders, I don't think so we should factor this as a reason to worry about as far as investing is concerned.
Okay, KK, great to have you on the show. Thank you so much for taking the time out and joining in. As always, good speaking with you.
Thank you.
Let's just revisit what the market has started off at. Well, it was all hinting towards a quiet start. We picked up quite nicely. So we're back at 17,450 now for the Nifty futures. It's the Adani group of names and beaten down metal names which are actually making a very, very strong recovery, and the breadth as well holding out nicely. So Tata Steel, Nalco, Hindalco, Jindal Steel, these are all your top winners. Gains of over 2.5% to almost 3% apiece on the futures. And then Adani Enterprises, which has sprung up about almost 5% along with some of the other Adani group names as well, which are scaling up very, very nicely in trade. Britannia is off though. It's down almost 2%. ICICI Pru Life, MFSL, TVS Motors and PVR is down 1.25% as we speak. But Ramdev Agarwal from Motilal Oswal Financial Services believes that the biggest profit pool lies in financials, banks and the IT sector. Here's a slice of his conversation with Nikunj.
So right now, the largest profit pool in India, which is growing also, is that of banks, financial services, and second is the IT. Okay. IT has had the most dramatic profit pool expansion from 2000. In 2000, it was not even a percentage of the total profit pool. Today, it is more like 15-17% and growing. And there is no year when it has not gained little share. So my sense is IT story is much bigger. You don't have to stick to the current set of those top big companies. They might give you 10-15% index return or something like that. But below that, there will be a lot of companies which will try to come into the big league. So there will be mid-sized companies which will, because their economics still remain great. And then you have the new set of kind of small companies which are coming up, product companies, AI companies, and so there will be specialized services companies which will be coming up, where the cost structure is in India and the clients are all in US and Europe. So I think that business model has huge potential. We have done in last 20 this is a 23-24 years story of Indian IT. And first $100 billion took about 20 years to get it, and next $100 billion came in just about 8-10 years. The third $100 billion, I'm not talking a small number, third $100 billion I believe is going to come in 4 to 5 years. So that's the nature of expansion, and there the players who are going to be disproportionately large, I think they'll make it, and we should be aligned to that.
A couple of years ago, you made this very famous presentation, the next $1 trillion opportunity.
That was in 2008 we made
exactly.
that. Yeah.
So if you have to make that presentation again, I'm sure the contours would change. So if you have to make that presentation for next 10 years, how will that presentation start? How will that presentation end?
No, the one is that starting scale. When we did in 2007, it was $1 trillion. We have already gone from 1 trillion to 3 trillion. So a lot of things what we said at that point of time, we should examine whether they turn out to be so. So clearly the discretionary spend, when you go from say 3.5 to 7 and 7 to 10 in next 10, 12 years, that's the journey. Now one has to believe that this journey is bound to happen, like 90%, I would say 95% probability that this is going to happen. So we are there. Now we have to see how to encash on that. How do we position? First thing is we have to be, if go by my 100% allocated in equity.
Okay.
So at least that
Don't time the market.
Don't time the market. 10-12% index return must come to us. So that is one thing. Now within that, there will be a lot of opportunities of value migration and market share gains, because digital power, digital economy is not very democratic. It's very consolidating. So winner takes it all. Even in a very not digital businesses, like say food delivery, there are only two guys to start with. They have not made a penny, and yet there are only two guys. So all the profits of this particular industry will be taken by two guys. So like that, we are going to see, say banking. I mean, the banking pool, profit pool this year is upwards of 2 lakh crores. Okay, and in next 5 years, it will be more like 4 to 5 lakh crores. In 10 years' time, could be about 10 lakh crores. In that profit pool, who is going to win? So there will be some digital players coming in, you know, and they will make it very big in next 5-7 years. Now, who is that guy? Who is that successful guy who is going to make it? That one has to spot. But I am quite sure in this spaces, some digitally powered companies will come and compound at 50, 60, 70%. And what for HDFCs of the world, which itself has done wonderful job at about 25% compounded. If you take it to 35%, at 35% it is just double, huh? Yeah. Compounding at 25 and compounding at 35 is just double the pace. So if you can get something at 35% compounded in 10 years, you can do wonders.
There's a class of 21. We're using this term called class of 21 companies which went public between 2021 and 2022.
Some of them will definitely make it.
You think some of them could make it big?
Sure, because that hype is busted now. There's no more hype. Last year, we were in November, December last year, there was a lot of hype, you know, crazy kind of valuation. And so those things are gone. 60-70% corrections happened now. Can it correct another 20%? That you cannot take it away. But now the promoters have also come to the senses. They also want to make profit. They want to make profit very quickly. And in any case, they want to make large profits. So some of them will be very successful. And some of the companies are very unique. I mean, there are no Me Too companies in that particular segment. So I think if there is a profit pool, if the consumer behavior has changed in some of the companies, clearly digital empowered companies are the companies where you can see few 1 lakh crore, 5 lakh crores companies coming in very quickly. I mean, if at all it has to happen, it will happen very fast. Otherwise, they'll just fall by the wayside.
When Zomato went public, you went on record and you said, look, you're not betting big, but you are open to exploring how this business is evolving. Has Zomato, any other business, any other companies where you invested in, have those businesses evolved as per your expectations?
See, this has been very dramatic. Last 1.5 years has been very dramatic from the, I mean, we are in listed space, so we cannot not take notice of what is happening to the stocks. So having seen that, but we are meeting all of them now. Again, we are meeting and we are trying to figure out where path to profits or size of the profit is going to be, and the current market cap, does it have, you know, some connection? Can we see light of the day in what they are saying that we are going to make 1,000 crores profit in next 3 years, 4 years? But they are saying so, but can we get confidence on that? So I think work is on. Let's see where exactly we put the bet. But the way to go about is put a small bets now, and a lot of things will go wrong, but don't leave it. Some of them will become very large. And out of 3 bets, even if one is right,
you got a next
one has to be right. You know? One has to be right. I think because it's going to be rocket.
Which one according to you?
I don't know. I don't have name. I don't have names on this.
Okay. There's one more, quote from Buffett's letter. You have to keep on learning if you want to become a great investor. When the world changes, you must change.
You must change. Yes.
This is coming from Warren Buffett, who says, look, I'm going to be sitting to my style of investment. I'm not bought Microsoft, but I bought Apple when my view changed. How would you like to apply this in your investment style?
We have not been, kind of a guy who says that, I mean, I have a dogmatic view of this way only. I have not quoted. We are flexible. I mean, we have, like in 2000, the tech, I made maximum money in tech. But he avoided tech at that point of time. In fact, I learned when to sell tech while in Omaha itself. So Infosys, TCS, Infosys and Mastech and all, we made tons of money. I mean, it went like berserk in 97 to 2000. I think stocks went 20x, 30x in just 2 to 3 years. So clearly that was the time we made a lot of money. I mean, we could understand the power of value migration in India in tech sector. And I think that migration is on. Now migration will move from the services company to specialized services. So we have to figure out where is that opportunity. And that itself will, see, now I think we have done a lot of local companies. Now time is coming in technology in some field, will give birth to some global companies, global businesses. Because internet is all over. So can we come out with a company which will take care of consumer needs all over the world? So yes, those opportunities are there. Let's see. I mean, opportunities are going to come from the conventional, because you're going to go from 3 trillion to 10 trillion in next 10 years flat. And that's almost a trillion every year. So that's a big opportunity. And we have to figure out which are the, see, you need two things. One is the business tailwind is there in almost all of them. Where is the management tailwind? What you need to figure out is that which are the competent, honest, hard-working, passionate managements who are there. And that, not necessarily that they are very expensive. It is for you to go and meet all those managements and figure out here is something which is very different from other managements.
I'm going to get two graphs up right now. First, QGLP, a thesis or a theorem which we've discussed with Ramdev ji time and again. But there's something very interesting which we've discussed and we don't talk about it, which is that a great business multiplied by a bad management is 0, and a great management multiplied by a bad business is also 0. That is the importance I think Buffett is also talking about in the newsletter. If India is becoming more like an asset class now, because globally everything is in shambles, why have Indian markets not given any return? At least the index has not given any return from last 16, 17 months now.
Now, after talking for very long term, now you come down to a few months.
That's my job.
So no, it happens. I mean, if you examine 16 months before that, you had a bumper return. So obviously it was way away. So there is always reversion to mean, and the stocks cannot fly. You are already trading at almost, you're the most expensive emerging market. You are trading at upper end of your own valuation at about 20, 21 PE. So once the earnings growth pick up, nothing is going to stop, I'm telling you. Once, for some reason, the earnings in this quarter you might have seen, except for financials, everything else was, you had the top line of 15-20%, but bottom line was flat or negative, because the margin compression is very high. Inflationary pressure on the cost side is not able to pass it on. So I think something will change. Maybe companies will be able to price it as we go forward. Inflationary pressure goes down all over the world. So we are able to pass on, and say, like you see the commodity companies, they had bumper profits last year. Now their profits are subdued. So I think the user of the commodity, I hope, will be able to price it and pass on to the consumers and improve their margins. So I don't know what dynamics will work, but right now, as we look at things, I think Q4 results are also not going to be very different than Q3. So margin, once the earnings explosion come, see, we have about 825, 830 rupees EPS for Nifty, TTL. And that valuation is about 17,000, so about 20 times.
That's trailing, but
I always look at trailing because that's the only truth.
That's in the price.
Rest all is estimated and can go haywire. Now next year, our guys are still at 950, but I don't think market is expecting 950 because if it is 950 or say closer to 960, 970, then market would have been far more buoyant. So as the market gets confidence on next year's earnings growth, I think market will. I don't think it is going to wait whether if I sell, they buy, market will just blast. India's 75-year history, you see, it has been slowly, steadily, like an elephant, it has been moving up. Okay, with all the challenges, they have just kept on moving. Kabhi 4%, kabhi 6%, kabhi 8%, 9% also we touched. But on the whole, we have been doing well. And markets have also kept track. Now, the country which has the longest, I think one of the longest compounded past. Now my sense is we are going to have next 25 years of compounded future. Now what does that mean? India, as we stand today, we are talking about 10 to 11% kind of a nominal GDP growth rate, because ultimately on a 270, 280 lakh crores GDP, we are talking about almost 30 lakh crores, 28, 29 lakh crores of additional GDP this year. On that, you have a 10% compounding every year.
Back with first trades, just let's take note of some of those Adani Group stocks that are recovering in trade. Adani Enterprises, a 6% move. Adani Ports, close to 1.5%. Adani Wilmar is in the green. Adani Green Energy, 5% on that counter. Transmission as well. All of those stocks are abuzz in trade this morning. A quick look as well as to what ACC Ambuja are up to, and some of those stocks as well are active in trade. Just let's flag off some of the other interesting movers within the broader markets, because you're really seeing an outperformance there. You've got something like an APL Apollo Tubes that's gaining traction. Avas Financiers is in the green. Varun Beverages, just earlier this morning, Hemang Jani was talking about this being one of his top recommendations. Rain Industries as well as Hindalco, along with EIH, which we don't particularly flag off too often. Those are some of the smart movers in trade. But let's get you a tidbit of the exclusive on ET now. Sanjeev Bikhchandani and Dipinder Goel, they come together for a chat like never before. The InfoEdge co-founder shares his rationale for keeping the faith in Zomato's growth map, saying that they are on track for profitability, and he also talks about what's on his radar next.
Sanjeev, you're the OG of the startup world. You were an investor. You understand this space.
The first time somebody called me an OG was a colleague of yours, a former colleague of yours, and I had to ask her what it meant. Okay, this was a few months ago. Now I know what it means.
Yes. So you don't like the word OG?
No, I'm okay.
It's cool, millennial.
It's millennial.
Your companies are invested in that. A lot has changed in the last 1 year. Exactly a year ago, there was a tinge of euphoria, lot of excitement, lot of re-rating in terms of where these companies were headed. But in last 12 months, de-rating, fear, anxiousness. Where do you think some of the consumer tech and fintech stocks will settle, and why?
It depends on the fundamentals. We have witnessed these cycles earlier. We saw it in 2000 when the first dot-com bubble burst. We saw it in 2008-9 when Lehman went down. InfoEdge corrected by 75% at that stage. And then slowly it came back. So if your fundamentals are good and you keep on growing and just focus on the business and not your stock price, it's going to be all right. It'll be different for different companies. So what I was advised in 2007 or 8 when Lehman went down by somebody who I regard as very smart, says, market goes up, you run the business. Market goes down, you run the business. Market goes sideways, you run the business. That's it.
That's what Dipinder to say, because he does not look at the stock price. He said, look, I've looked at the stock price only 3 or 4 times in the last 6 months. But you are an investor, which means you need to look at the stock price.
Not really. We are long-term investors, so we don't even track our own stock price daily, right? So the conversations we have are not about the stock price. The conversations we have are about what's happening in the business, what's happening on path to profit, what's happening on growth, what's happening with competition, what's happening on any new initiative, what's happening on Blinkit. So we have operational discussions more than financial discussions.
You've not pared down the investments in Zomato, while other anchor investors, other big investors have bought their stake down. You're still the largest investor in Zomato. What gives you the confidence that this is an investment which already has been a multi-bagger investment for you, could still create wealth?
So look, I'll be unfair to InfoEdge shareholders if I say we'll never sell. We are constantly alive to the issue.
Sir, you will sell one day.
Of course. But as long as we believe there's a future and there's growth, and I see no reason to sell unless we need the money for something else, right? And that's what. But obviously, we discussed with the board, but there is no announcement we made here on this account. But I do believe that if there's growth, we should stay.
What gives you the confidence? You're speaking about the growth part. That growth is real. There are a lot of businesses which start young, but it's only when they start growing up, the base effect or perhaps the need of that business gets challenged. Now, for you to grow, there are two things which is important. You have to solve a need of the society, which you're beautifully solving, but also pricing power and efficiency. What gives you the confidence?
I think the confidence which I get is from the behavior of the customer over time, right? I think there's a lot of people who are just starting to like interact with restaurants. So, and I think maybe 70-80% of the base is right now 4 times a year kind of a frequency, which is doubling. That gives me the confidence. Like, even if we don't add any like new people to the platform, even then we are going to continue growing for the next decade. So we're just at the early. I think it's a very, very early stage business right now. Profitable as well. So.
It's always, there's always a yes, no. There is no right and wrong. But why is that startup founders have this maverick image? And there's an investor here. I'm going to ask him the same thing. But there's an image, and this is not an India image. This is a global image. That startup founders are Mr. Mavericks of the world.
I don't know. Why do you think so?
I think that's more myths. I mean, if you're inside a startup, people are making rational decisions, rational choices. Startup founders very often tend to be young. They don't wear suits and ties to office. I don't know, do you possess a suit and tie?
No, I don't. And
You don't have a suit and a tie?
And I think given the recent news, there are so many large companies which have been taking maverick type calls, right? So it's not necessarily up to us. Like, so it's just a young versus old image, I don't know.
So look, when you don't conform to stereotypes that society has in the past, expected from people in business, you're called a maverick sometimes. But it's okay so long as the business is good, products are good, customers are happy, they're being serviced, and you're getting growth.
It is also a question which has been asked, and I'm going to address with
Actually, like that, if Dipinder will turn up for a meeting or an office, completely clean shaven in a suit and tie, and say, "Boss, is the business okay?"
But when was the last time you wore a suit?
15 years ago, maybe.
Actually? So when you meet your investors, even global investors, you don't have to wear a suit?
I don't have.
And
nobody actually expects me to. I think if they see me in a suit, they would not buy the stock.
So one of the indicators now, apart from watching the valuation here, is that Dipinder suit ka pen raha hai. That is the point which investors should look forward to, right?
Possibly. Possibly.
The accounting disclosures. Again, a lot has been talked about, not just Zomato, but in general startup companies. The disclosures are changing. What about part 2 profitability? Will it keep on changing? This was adjusted this time, attracted a lot of attention. Let's hear your thoughts.
So, I think Zomato releases EBITDA and then it gives adjusted EBITDA. Now, what is EBITDA being adjusted for? It is being adjusted for a non-cash expense, which is the charge this quarter of ESOPs awarded just before the IPO. Right? Now, why is it useful for investors to know adjusted EBITDA? It's because real cash flows will give an indication of what the future might be like. Right? If you just give EBITDA, the retail shareholders, for example, may or may not have the knowledge and expertise to remove ESOP and say, okay, this is what real cash flow is. Now, is ESOP a real expense? It is a real expense, no question about it. But the truth is that, is it a real expense that's going to be repeated? Thus far, at least, the thinking in the company is unlikely. And therefore, there's a one-time ESOP, but it is being charged every quarter for the next X number of quarters. So therefore, I do believe it is a good disclosure, but don't just look at adjusted EBITDA, also look at EBITDA. And Zomato reveals both.
Whether it is, Policy Bazaar or PB Fintech, or whether it is Zomato, a year ago, the general mood was that the path to profitability was not defined. I know markets are obsessed with it, and we've asked you this question again and again because that's a benchmark. It is like saying that when you are in the public market and when you're private market versus public market, the arena has changed. वो कबड्डी था ये खो-खो है, game ही change हो गया. Do you believe in that?
So,
market's obsession with part 2 profitability.
We invested in Zomato first in the year 2010 in June, right? maybe August, June, August sometime. I think June we sent the term sheet, and by the time the money went into July, August. And I have correspondence from then, around October, November, asking Deepinder, saying, I want to see cash flow for next 3 months. So they were doing 1 lakh of revenue. They just raised the money from us, and we were already talking cash flow, and they gave us a projection. So is Zomato, is Deepinder, is the management team conscious, capable, aware of the importance of revenue, cash flow, profit? It certainly is, and it always has been. Now, in a market which was offering lots of capital, where competition was raising money, did they raise a lot of money? Yes, they did. Did they run up losses in order to get market share because competition was spending? Yes, they did. But perhaps that was a smart thing to do then, right? But they have always been conscious of profit. In fact, in 2015, when there was a bit of a funding crunch in the market, they pivoted to very close to profit in that year.
So Deepinder, if I say that for those who are obsessed with this entire concept of cash flow and path to profitability, they are missing on the big picture. It is like saying that you are focusing on the trees, not the forest, because you are a high growth company, and ultimately when you are in a high growth company which is solving the need of the society with innovation and with convenience, it's not 1 year, it's not 2 years, it's really a 10-year journey, and which is why you would flourish.
I think every company is built in a different way, right? So, and some businesses take longer to get to profit, some take less time to get to profit, and sometimes things change as well. And I mean, path to profit, profitability, growth, all are part of the forest. So I think you have to look at everything. There's no such thing as you can look at one thing and not really look at the other. You have to look at everything at the same time.
So I'll give you one instance,
yes,
right? Just a while back, I was sitting with Deepinder, right? And this company has an app where they track sales live. Okay, so they can look at sales every hour. What is the growth over yesterday? What is the growth over last week in the same hour? On the same day, for the full day. At 12:30 a.m., just past midnight, they get a report on the app which says profit made yesterday.
So you called him at 12:30 at night?
I don't.
Okay.
He gets an app. No, I don't get it. He gets it, right? So all I'm saying is that if there's a company that is more capable in terms of their own consciousness and MIS and information and awareness of what is the sale, what is the growth, what is the profit, they can track it to the minute and to the day. So this company, to my mind, is very well geared, all control systems, all reporting system, to track profitability, profit, and therefore they'll get there.
Buffett has this very famous quote which says that for great companies, our holding period is forever. For you, does Zomato fall in that category?
It well might, but I don't want to say it because I can't say that for my shareholders.
What will be a trigger point for you to sell Zomato? Could it be valuation, or could it be you find something else? Because ultimately it's an investment for you, and investors are not emotional about investments.
So look, the real issue is going to be, is there growth left, and over what time horizon, right? If Zomato goes to 150 tomorrow, should we sell? I don't know, because it might go to 300 day after tomorrow, and it might go to 750 in 5 years. We don't know, right? So we'll not look at the stock price. We will look at the business fundamentals. Are they headed north? If they are, will they keep on heading north? If they will, I think it's a good thing to hold. Unless we need the money for something else.
If I say, Deepinder, that Zomato has ambitions and it is working towards being India's biggest internet company, all platforms put together, and the ultimate goal is to be north of $100 billion. Will that be a tall order, or that is something which is not a very high watermark for you?
I mean, the watermark is certainly high, but I mean, we are trying to get there, right? So, and
are you working towards it consciously?
We are actually working towards that consciously.
Sanjeev, whether it's a myth or a reality, the general view with the startup and the internet companies is they've got money when the interest rates were low, and they've got capital when interest rates were different. Now cost of capital is going higher, but they will not change in terms of their attitude towards burning capital. It is the money which they've got by equity raising, and they will continue to burn it. Is that a myth, or there is serious?
No. See, in my view, it takes 6 to 9 months for a young startup founder who's raised capital to really internalize that the market has shifted and changed, right? That he may not get the same money so easily at such a valuation going forward. Once that realization sort of dawns on the founders, I think they're very agile and very quick and very smart at pivoting. And we've seen that in company after company.
So for those who think that, okay, this entire internet, mania in India was more like a bubble, it has got pricked. Do you think you would dismiss that?
So let's look at past bubbles, right? Let's look at 2000.
Yeah. The TMT bubble.
Yeah. Now, at that time, it was a bubble, and it did burst. But the truth is, when that bubble burst, there were only 4 million internet users in India. So you were getting venture capital, you were getting a valuation, the market was potential only 4 million people, right? That reality has changed fundamentally. Today you have hundreds of millions, maybe 1 billion people who are, and more coming on every day, who are using the net on the mobile and are potential customers, or eyeballs are important, right? And therefore that fundamental has changed. So while valuations may have been frothy and they may correct, the underlying market size is real. And therefore businesses will get built, sooner or later profits will be earned, revenue will be earned, and companies will become valuable again.
If India has to become a $5 trillion economy, and we are not debating when, it is a matter of 3 years, 5 years, or 6 years, that's the debate what we have. Do you think companies like Zomato or Policy Bazaar or a Paytm, this entire internet cahoot, will have a very large role to play?
Certainly. So not just these three, I think many startups. So if you look at, so I joined the workplace, I joined industry, working in industry in 1984 out of college. Right, that's about, 39 years now. There's a sea change in the business landscape, industry landscape between then and now. It's not been a revolution, it's been an evolution, right? But if I look back at, much of the growth, much of the increase in employment, much of the increase in market cap, much of the buzz, the investments have come from companies and sectors that did not even exist in 1984 or barely existed. Yeah. IT services barely existed. IT-enabled services did not exist. Internet did not exist. Mobile telephony did not exist. Mobile apps did not exist, therefore. Private sector airlines did not exist. Private sector banks, only a few legacy ones, but the big ones did not exist, right? Private sector airlines did not exist, right? PPP partnerships in infrastructure did not exist, right? These are all new initiatives. Very often, these new initiatives are from first-generation entrepreneurs. Some are diversification to large companies like a TCS, but an Infosys, an HCL, they were startups in 1984. Now, you look at them today, let's take two companies, HCL and Infosys. Yeah. Startups in 84 when I began to work, giant companies today. Look at the market cap. It's pretty clear. HDFC Bank did not exist. Yeah. Giant company today. Look at the market cap. So it's pretty clear if history is to repeat itself, that the giant companies of tomorrow, very many of them are startups of today. Now, will these three specific companies do it? I hope they will. But in general, the family of startups will yield giant companies tomorrow. It may not be 5 years, maybe 20 years, I don't know. But the future belongs to the startups of today.
That's a great point, right? That if India has to become a $3 trillion to a $5 trillion economy, the profit pool, which is what markets always focus on, the profit pool will come from the entire innovation or the startup space. Whether it is Zomato, Policy Bazaar, or Paytm, we don't know, but that is where what we should focus on.
Hopefully, yes.
And is that the right way in which your shareholders should look at it? Because we've addressed the two pillars: customer satisfaction, employee concerns, and employee culture, something which you've alluded to. Now the shareholder, the third part. What should shareholders look forward to?
I think it's about the intrinsic growth in the business, right? And the ability to make profit. And I think the way I actually evaluate a startup is that if this company or the set of companies which actually compete in this particular space they actually like shut down, will somebody cry? Okay. So if nobody is going to cry, then I don't think anybody has created value somewhere. Like, but if some people are going to cry, like then that's when there is actually real value there. That's also when I think profit comes out of that state, right? So I think Zomato is one of those like companies where if we actually shut down, a lot of people would cry. Right?
I'm going to cry for sure. No milkshakes for me. No late night
Sanjeev's
food
gonna
for
cry
me.
for sure
No
as well.
pizza for me. What is the one thing you constantly order on Zomato?
I mean, many things, okay? But it's Mughalai, biryani, all the stuff I don't get at home.
Just to wrap it up with one final point. What is that one advice which you always got from Sanjeev and you always ignored? I'm a shareholder, I'm a promoter. I know how to run my business.
I think the biggest thing Sanjeev told me, and that was probably the first time or the second time he met me, was that there are two types of people or two types of startup founders or founders. The ones who actually make it, and the second type is the ones who quit. So there is no third type. Right? So
Yeah, we had
that
told
stays with
him,
me all the time.
that, listen, we're giving you money. Whatever you do, don't quit. Don't say I'm going to do my MBA in the US now. You know, I said, I don't want to hear 2 साल बाद कि अब मेरा हो गया, मैं MBA करने जा रहा हूँ.
One last question. A lot of people look up to you to understand that Info just got Zomato right. They've got Policy Bazaar right. They've got a lot of other business right. And every time when you come on television, you're supposed to make a big prediction. So, where are you investing next?
So we
What are you looking at
we don't invest top down. We do it bottom up. So we don't look at sectors. You know, if in 2010 somebody had come and told me, hey, you know what? Look at the restaurant listing sector. Koi sector nahi tha, right? We would not run Zomato. If in 2008 somebody had come and said, you know, why didn't you look at insurance comparison? Then no company existed. We look at it bottom up. We meet startups and founders and see if they're doing interesting stuff. Doesn't make sense, and if it does, we back some of them, right? We sometimes get it right. We often get it wrong, right? But the ones we get right more than make up for the ones we get wrong, or ones that are taking extra time. So it's bottom up. It's not top down, and we evaluate each on merit.
We started interaction with OG. Let's close with OMG. What is the OMG moment for you?
Well, a eureka moment for me. So I'll give you 2 eureka moments. One was Policy Bazaar, right? Policy Bazaar, we invested on a PowerPoint. The product did not exist.
Really?
Yeah.
No due diligence?
I mean, we did this
What
as guys.
diligence do you do in a
We did this as guys.
You're beating the Shark Tank promoters here.
No, we did this as guys. So, the founders had experience in the same field. So there was domain expertise there. But Yashi sat across the table from me and he said, I'm willing to bet that you're paying 60% more for your car insurance than you need to.